Months ago, we have officially entered a downturn in the real estate market. This is a cyclical thing that happens regularly, but we thought it would be timely to speak a little bit on how we manage risks through a downturn, because it does take a special skill set. It's easy when the times are good. When the times are tough, how do we manage through that? And I'd love if you could speak a little bit to it, and I'll bounce back some ideas as well.
Let's start with the idea that cash flow is king. So we focus on cash flow, and for a long time it was that we bought for basis and then cured problems. The problem is that would sometimes mean buying at a 3 or 4 cap because there was so much upside. These days we're more focused on buying for cash flow, cap rate going in, and your untrended yield on cost, which is the idea of if you brought everything to market, what would be your built-in cap rate?
Yeah, I'd say essentially during a downturn, we all accept less risk in the current environment. You know, when we're in an upcycle, I'd say the market has the ability to accept more risk because it's an upcycle. But in the downturn is when we really start to focus on things like cash flow and making that a bigger component of return.
We also set aside more property reserves going in, so it's more IRR efficient to harvest cash flow to fund future CapEx or unit turns or leasing and tenant improvements. That said, in today's environment, we lead with more cash up front. We reserve more. That has a little bit of a negative effect on internal rate of return, but provides a greater measure of safety and increases cash flow during the hold period.
We also apply conservative debt to our investments. This is true regardless of market cycle. We've always had a preference for fixed rate debt, for balance sheet lenders, generally low leverage. I think our portfolio leverage right now is 55-56%. And that gives us so much more margin of safety, because when you're at a high leverage and the market turns, you can find yourself very quickly out of the money, so to speak. But when you're at in a lower leverage position, you have stronger cash flow and you have stronger debt coverage as well.
What's interesting is this year has seen some big changes for us, in that for 50 deals prior to this year, or about 50, we had walked from very few. We had a great reputation for getting into escrow. We always close. The challenge in today's environment is it's hard to make deals pencil. It's harder to capitalize them. It's hard to get the right debt. So this year we've had to walk from 3 deals. That's something we haven't done before. But the lesson learned here is always do a thorough due diligence, but cut earlier. Like in times like these, things are choppier, and 3 times we've had to say we're walking away. This deal isn't right for us. That's been really hard to do. It's been a sort of culture change for us as a firm, but it's been necessitated by the current environment.
Yeah, and this goes back to kind of risk aversion. When we're in an environment like this, we all the more are having a preference for lower risk strategies, even if that means that we're taking a little bit on IRR.
Then it gets back to our sort of fundamentals. We self-manage the majority of our properties. We're aggressive and skilled managers. One of our strongest suits is we are great building operators, and we come up with creative strategies. We maximize income. We manage expenses tightly, and we predominantly or almost exclusively do only multi-tenant buildings. So in times like this, diversification is super important. Mm-hmm. That means both diversification of tenancy, but also diversification of markets. So we operate in 7 different markets, and we spread our risk that way, and also amongst the tenants.
And fundamentally, as soon as we buy the asset, and again, particularly in this environment, we focus aggressively on growing NOI, growing net operating income. So having that control of the outcome is really important in that. I think our Fund 3, if I remember correctly, we've grown NOI 27% to date. And that fund was mostly purchased in 2022 and 2023. As the market is declining, it allows us to at least help maintain value and offset those market declines by that aggressive focus on growing net operating income.
That said, I think it's important to conclude by saying it's not all bad news. a portion of our portfolio is office. We're seeing greater leasing activity on that than we have in maybe 2 years. On the industrial side, there's plenty of deal flow. In some markets, rents are down a little bit. In some markets, they're full bore. I don't know if it's people are anticipating a rate cut and they're getting more active. Maybe it's that some parties have called a bottom. The point being is the consensus we hear on the street is we're at a bottom, or we're bumping along, or there's plenty more to work through, but there's good news ahead.
Yeah, and I think our job is to keep our heads down, focus on the asset and taking every asset and creating as much value as we can, and to some degree, letting the market cycle solve itself while we focus on what we can control.
I think it's also important to note that the herd is not moving yet, and it's our jobs to act and be a level of aggressive. Aggressive is probably not the right word, but it's our job to move when others aren't. And now is a time to be active, maybe not aggressive, but decisive and active. In 6 months or 18 months or 12 months, things are likely to be different, but there will be, and we have found some really great opportunities that exist now. It's important to be really disciplined and selective, but that's what we're doing.